Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome, everybody. I am Jeff Barton, and this is the Mortgage Voice, and welcome to the show. We broadcast the show each and every week from KCAA out in the Inland Empire, the IE, over at San Bernardino and Riverside counties. I want to say hi to all my fans out there. Really appreciate you listening in. We also are on YouTube, Jeff Barton, the Mortgage Voice, YouTube. If you want to see this show, all the archives of the show for hundreds of shows, many years, you can go to YouTube or just go to the KCAA website and you can look up the archives of this show. We talk about real estate. We talk about mainly mortgages, how the world is affected by you, or in the reverse, how you are affected by the world. There are plenty of micro out there to talk about in terms of specifically what you need in order to get a loan. And we have guests that come on the show and describe exactly that. And today is no exception. On the macro level, some of the world events that take place, we get wrapped up in either politics or wars around the world, famine, all kinds of different weather-related issues, which are maybe not affecting your particular area or your neighborhood, but because of the fact that they exist and they are driving market conditions which affect your mortgage rate, the money available, and risk. The risk out there is plentiful, and depending on who and where and what you're talking about and who you're talking to, that risk will sound different. And so we try to really simplify it by saying, look, this is the way it is today. This may affect you here. You need to make some decisions. Look, I do not have all the answers, and most of the people that come on the show, they have answers about, as I said, the specific nature of what they're talking about. But for the most part, a lot of this stuff is opinion. And just understand that when you're listening to other people talk about the economy, whether you're talking about mortgage rates, real estate, a lot of it is conjecture, especially when you're talking about the future. 2 years ago, could you have predicted that interest rates would be 7.5%? No, you couldn't, because nobody thought 3% was going anywhere. They thought, okay, maybe 5.5% on a 30-year fixed rate mortgage. Oh my gosh, that's so high. Well, historically, of course, we all know that the way the interest rates are today are really not that high, historically. However, because we've been through the pandemic, and the pandemic saw a lot of different things helping consumers, driving mortgage interest rates down, providing monetary solutions for either you don't have to pay your rent, or you don't have to pay your mortgage, or here's a check in the mail, here's another check in the mail, and all of these things which led the economy into the highest inflationary spiral we had seen in 40 years, maybe even longer. So the sobriety of those days has given way to what we have today, which is an uncertain market, right? We have interest rates, as I said, about 7.25. Let's just get to the interest rates, and then we'll move on. 30-year interest rate today is at 7.29. 15 years at 6.70. FHA is at 6.88, 7.35 for the jumbo, and 7.18 for the 5/1 ARM. Note that the jumbo is at 7.35 and the 5/1 ARM is at 7.18. These are higher than the 15, higher than FHA. Normally we would see these rates a little bit lower, just because the nature of the loans themselves. And as we detailed last week in the show and the week before, jumbos are a problem for many lenders who lent out money at 3%. Nobody who has a jumbo loan, and we're talking over $1 million, right? In some areas it's $750, but even super jumbo over $2.5 million. If you have a rate 3-4%, there's no way you're going to be giving that up until you absolutely have to. Now, a lot of these jumbo loans are short-term, 3 to 5 years. Some are longer term, but if you have that rate, you're riding that 3%, 4% rate all the way to the end. And that's what's killing those particular lenders, which is why nobody wants to do them, and the interest rate on jumbos is 7.35%. If you have a paper and if you have enough money down in order to get that rate. So those rates, these rates that I quote today to you are for the best borrowers, not borrowers who are business bank statement borrowers, FHA borrowers, credit challenge borrowers, borrowers who want to be able to get as much money as they can without disclosing as much as regular 30-year fixed-rate loans demand. So all of these things together, yes. So where are we in this cycle? We're in the cycle of fact-finding and knowledge. Employment. Okay, so employment numbers came out today, very interesting. We saw the unemployment, I'm sorry, not the unemployment, but the rate of jobs to job openings fell again, and it's down around 8.5 million. For months, we were talking about the amount of jobs that were available in the marketplace in the U.S. were 10, 11, 12 million. Well, now that particular number has fallen to 8.5, 8.2, I believe, million jobs. What does that mean? It means that the labor market is becoming more evenly balanced. It's a better way to term it rather than the up and down. We tend to look at these figures. China, another example. We tend to look at everything as if it's yes or no, or black and white, or win or lose, like it's a football game. It's not like that, because the interconnectedness of not only economies, but societies in general, and how we look at things makes it so we have to temper all news by understanding how it affects us individually, how it affects our neighbors, the neighborhood, and the country at large. Because, like I say, it's not so great that one thing happens and it makes a temporary adjustment in your area a good thing. Because those things that are in a negative way economically, if they're hurting a certain group of people, that means the demand from that group lessens, and that hurts everybody. We are driven by a consumer-based economy. That means that everybody has to have the opportunity to get out there and buy and sell properties, buy and sell mortgages, buy and sell things to eat, to drive, to play with. All of these things are very important for the U.S. economy. So when we look at numbers like, okay, we've had labor force in this country in charge, meaning I'm going to stay home from my job. Maybe you're staying home from your job. Maybe you're saying, you know what, it's the pandemic is over, but I still have leverage here because there are so many jobs in the marketplace, I can go anywhere. Which means that I can tell my employer, look, I'm staying home, and I need a raise of 4% a year. By the way, we've had a 4.5% raise in wages over the past 12 months. But if we see that number of available jobs open in the marketplace fall from 11, 12 million down to 8, 8.5 million. Now, granted, that's still a lot, but it shows that the consistent, persistent raising of short-term interest rates by the Fed, having both an economic impact not only on mortgages, but also on the unemployment jobs available. This means that an employer can now say to you, hey, you know what? Maybe we want everybody back at the office. There's a control issue. There's an argument on productivity issue. Regardless, that puts pressure now back on the employee. It also means that instead of 4.5% in terms of the way we have paid workers more this year than last year, might be 3%, 2% next year, maybe even break even. So the pendulum of how that affects you is going to affect how much you can afford to pay in your mortgage. Now, if you're out there right now and you're a first-time home buyer and there are two of you working and you're making $100,000, $150,000 a year, where are you going to be able to go out and get a mortgage to be able to afford a $750,000, $500,000 to $750,000 house, which is what they're doing in San Bernardino and Riverside? This is the issue that affects all of us. And because of all these contributing factors, for instance, you may be and have been able to stay at home, work, get paid more, and not have to pay for childcare because you're at home. If that goes away, these expenses increase. Therefore, you're stuck in renting rather than buying because you just can't foresee how you're going to be able to pay for additional childcare as well as a high-priced mortgage, which is, what did I quote it as? 7.29 for a 30-year fixed-rate mortgage. That's a reality out here in the marketplace as we see it today. There's a ton of information about those specific things that happen in the U.S. I want to compare it a little bit to some of the other places around the world, just so you get an idea of the differences and why those differences are affecting choices and the ability for you to be able to pay for a mortgage and buy a house. I'm Jeff Barton, your voice in the mortgage industry. Thanks for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. You know, if you want to see this show, you can go to YouTube, Jeff Barton, the Mortgage Voice. We have this week's show, last week's show, hundreds of shows there. You can kind of see a trend from the beginning of the year as to what we thought then to what we think today. And most of what we deliver on this show is opinion based on, you know, all the reading that I do about what's happening in the economy and what products are available to you in order to afford a mortgage. There's certainly been a trend towards non-QM loans. A non-QM loan means that you have less documentation in order to get a loan, but the interest rates and the costs are higher. It's a trade-off, but a lot of people like that, and there are more opportunities in that area just because of that. And companies that are actually doing those type of loans don't necessarily sell to Freddie Mac, Fannie Mae. They keep it to themselves, or they have deep pocket investors, hedge funds, sovereign funds. I mean, there's a lot of ways that you can skin that cat in terms of getting money from mortgages, but that is what is happening. If you want to hear the show, you can go to a number of podcasts that we have, which I believe, Daryl, do you have a list of those?
Yes, I do, Jeff. It's Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and themortgagevoice.com.
Excellent. Go to mortgagevoice.com. You can see me there as well as all of the guests or many of the guests. You can contact them directly, mortgagevoice.com, and certainly podclips.io. I'll give them a great plug right now. Centralizing your podcast needs, finance, health, let's see, what is it, sports, current events. What else do I have?
They've got some mediation folks on there that talk about how to settle things out of court.
And you know what? If you are in any kind of mortgage or any kind of real estate related business, you know how important these people are at the EDR, what they call alternate dispute resolution people. And anyway, if you go to the podclips.io, you can reach all of these people just with a click and a listen. I'm Jeff Barton. This is The Mortgage Voice, and thanks for tuning in. Okay, we were talking earlier in the show about some issues nationally and how decisions are being made at the macro level that will affect your particular way that you go about your daily life. And if you're trying to save for a mortgage, that's not an easy thing. There was some calculations done about how hard it would be to save up 5%, 10%, 20% if you wanted a certain rate or if you wanted to be able to afford a certain type of mortgage. And it was determined if you had a cup of coffee from Starbucks and it cost you $3.50 a day and times a week, times a month, times a year, how many years, and at the end of the discussion and the calculations, it was considered prohibitive, meaning it's never going to happen because the rate by which your deposit that you need, 20%, 10%, 5% even, was so high because the prices of real estate, San Bernardino, Riverside counties are so high that you just are never going to be able to afford it. So being able to figure out a better way to do it. We've had on the show many times people who talk about doing a down payment assistance program, and that down payment assistance program can be a forgivable loan, meaning that you will pay, let's say, an FHA price of 96.5%, you will get a loan on, but you'd have to come up with 3.5%, but the down payment assistance would be able to cover that at least 3%, so you're really only coming in with 0.5%. Now that's doable for a lot of people. It's more expensive, and you pay insurance for that, but you can afford and get into a home. So these are some of the options that are available out there. Okay, let's get to some of the housing market news, and there's a lot of it, so bear with me. First off, in housing inventory, down about 9.3% year over year. Now, some of the data that comes out is always tricky to read because they mix monthly and yearly data. For instance, they could say that the monthly, month-to-month data that we've had a 14% increase in the inventory from last month. Sounds great, right? But if I just quote you 9.3% down from a year over year, you go, oh, well, what is that telling you? It's telling you that it's confusing by design. There's less properties out there to buy, let's face it. And they're more expensive because there's less of it. Now, there's still plenty of people out there who can afford a 7%, 7.5% mortgage. Now, you can buy down the rate, and you can also put more money down, which gives you less of a loan, less of a monthly payment. Both are ways by which you can lower that monthly payment. Many people for years looked at the lowest monthly payment as the only way that they can afford to get into a property. There are ways that you can get into a property with more money down, obviously, which will cut your interest rates, cut the amount of your monthly payment, and of course you can buy down the interest rate. Now, usually what does that mean, buy down the interest rate? There's a way by which you can purchase properties now called a 3-2-1 buy down or a 1-2-3 buy down, meaning that the seller could contribute to buying down that rate. And it would be an introductory rate for 3 years, then 2 years, then 1 year. It would step up to whatever the rate is that you had. Today it's 7.3%. It's an interesting way to buy property that the seller would contribute to. The question always is, can you roll the increase, i.e. the money the seller pays you, not pays you, but buys down the rate from the bank for you, into the price of the property. So if you have a property that's worth $100,000, it's going to cost you $5,000 to buy down the rate on a 3-2-1. Can you now sell the property for $105,000? That is a question, of course, for the appraisal and the lender. This is not a question by which what is and what isn't illegal or legal to do. It really depends on the nature of the loan, the nature of the lender, and obviously the seller's willingness to come in and do that kind of calculation. There is some interesting notes about the GDP and what's happening in Q3, or what's about to happen in Q3 based on what's happened in Q1, Q2. Now, we occasionally go to the big board and talk about Bank of America, Goldman Sachs, and the Atlanta Fed and what they have to say about these particular numbers and what's coming up. We have seen the U.S. make a remarkable recovery from the pandemic and has staved off so far the recession that I even predicted as early as a year ago and had still been talking about 3 or 4 months ago. Since that time, I've bent to the, I don't know, one of those words. I've bent to the will of whatever the economists are talking about, economists are talking about in terms of will we or won't be. So now we're talking about soft landings or maybe no landing, meaning that there isn't going to be any kind of a recession or any kind of economic hit to the fact that we've lowered the inflation rate by raising short-term interest rates by the Fed many, many times to whereby now it's between 7.5 and 5.5 and 5.75 to the Fed funds rate, which they lend interbank and which affects all things about lending and monetary policy, not only here in the U.S., but kind of around the world, really. Okay, so Bank of America, the GDP in Q2 was 2.4%. That's what they said was going to be the gross domestic product for the year 2023. Q3, 2.8%. It's predicted. That means we have another month left. We're about a month and a couple, 3 days till the end of the third quarter. But that means the prediction for GDP is up rather than down. And Goldman, 2.6%, and the Atlanta Fed says 5.9%. All of these bode well for the economy, meaning that if we stay above, obviously, negative growth for 2 quarters in a row, we will be in good stead. Now, we've had some troubling news in terms of what's going on globally when it comes to oil prices. We've seen oil prices here in the U.S. continue to climb. And what I mean by oil prices, gas prices. Everybody's paying more at the pump in gas. Anybody's out there at San Bernardino Riverside, you know exactly what I'm talking about. And you probably have to commute quite a bit. A lot of people from either Los Angeles or up to 15 or, out to 210, whatever it is, you know what gas prices are. The curious thing, and this is the thing I've never really understood, is that we have let's see, how can I put this? The United States pumps more oil than any country in the world and has been doing so for over a year. And now during the last political administration, that was a big thing, right? We're energy self-sufficient. And this has been the drive of many people's mind. Well, we have all this oil, we have all this shale oil. How come we are not energy sufficient? I mean, we should just pump our way out of any issues with the oil. Well, we are. We're pumping 15 million barrels of oil per day. And yet, gasoline prices in my area go up and up and up. Why is that? What's the correlation between pumping and gasoline? It used to be direct. You pump more, gas costs less. Not anymore. This is part of what we wanted to talk about when we talk about economies, whether it's U.S. or Western-based economies, to whatever is happening over in China, which is another issue I wanted to get to a little later in the show. Anyway, I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us week after week, month after month, year after year, bringing you news. Whether it's good news or bad news, it's current news, and a lot of that can help you make decisions about whether you're going to buy, whether you're going to sell, what kind of mortgage you need, whether you need to, go into the savings a lot harder than you thought you might. There's all options out there on the table right now. Real estate prices have really gone up, and we bring on the show people who know way more than I do, who have been in the business a long time, and Luke Mankey joins us, is that guy, and has been doing it for, I don't know, Luke, how's it been, 10 years now, maybe more?
We're coming up on, I started in wholesale in 04, so I guess I'm starting to creep to that 20-year mark, but long enough.
Well,
long enough.
I appreciate it, always appreciate you, as I've told many people in the past, my own particular deals, people that come to me for a loan personally, I always hand them over to Luke because of the thoroughness that you give to each client and the number of choices that you're able to present. And I think that's really speaks to not only your commitment, but also the way that a consumer today has to be talked to is a little bit different than the hunt 'em, tell 'em, and sell 'em days that were back in those early days of 04, 05, 06.
Yeah, yes. No, you're absolutely right. It's, you go in a house, you want to refinance, we can get you a loan. Anyone can get you a loan, usually easy. Sometimes there's some hair to it, and it takes some creativity. But yes, this is very much a purchase market, and everyone's, they may be making less, they have less, they've got more limited options, and so you have to really dig in and provide value to find a way to kind of have it make sense. Is what I'm finding, at least. The people that I'm working with, it's a lot of, you need to work hard also to just find them the best, most aggressive deal out there, because not all these lenders and banks are pricing as aggressively as they could. So it's, but I enjoy the challenge.
I was in U.S. Bank the other day, and they had an offer of 4.5% for a 2-year or yearly CD. And I'm thinking, the way banks price against each other, I think most of these types of advertisement in banks, like mortgages or like anything, is for the customer that comes in the bank. Because 4.5% on a CD for a year, you can get almost another 2 points if you went out there and looked. So
Yep.
it's really, a guy like you who would see a customer who may be lazy but still wants the best deal, providing them with the examples of, like you say, 2 or 3 different lenders. That, this one has an advantage here because they might have a 3-2-1 buy down. This one has an advantage here because the rates are a quarter, but you got to lock in within X amount of day. It's that type of nose to the grindstone effort in a tough market, and it's been a tough market, that really makes a difference for buyers.
Yeah, for the buyers, and then for the sellers as well. Like I found, you're getting these listing agents. I don't know why. I'm tending to be dealing with people that are still buying in these affluent, competitive markets. I mean, not everything is softening right now. There are definitely parts of Southern California. There's places up in Washington State. Those are kind of the 2 states I put quite a bit of focus on. The areas where most of my clients are looking is still competitive, and you get these listing agents on the phone, and I think if you provide that thoroughness, as well with them. That's what at least I found. Out of the handful
Okay.
we closed a few months ago, I think they're appreciating that as well. So yeah, it's not always. Some people are cookie cutter and it's very easy and they can go anywhere, and then other times they're not. And I think that you're probably compensated and rewarded for just learning more. The longer I do it, the more I just naturally feel like I really got to learn all facets or as much as I can to be that
Right.
much of a solid, reliable resource. Because
well, I would consider you a veteran in the business, right? Been around a long time, not the candlestick maker, the milk person, people who jump in the business when times are good, when times are tough like they are now, just because, as you said, competitive real estate market, competitive mortgage market, rates going up, scarcity of product, all of these things require a real knowledge. And then, of course, the desire to be able to want to help people rather than just, get them into anything.
Yeah. Yeah. No, I mean, I don't know. It might be easier to just go try and sell cars or insurance or something when it's slow, but I've never done. I'm not going to do it. But you're right. I think a lot of people do jump ship and then come in when it's easy. And I just, that's, people see through that, in my opinion.
Yeah, I do. I agree.
Yeah.
I agree. Okay. Tell us about some of the programs. Give me a popularity. You were talking a little bit earlier to me off air about a Washington deal, setting up a client that was trying to get into a purchase. Didn't happen, but they're still aggressively looking. What kind of products are you offering in these competitive markets? Is it still 30-year fixed? Is it, some hybrid thereof?
With this one we were looking at, and this is probably helpful for some listeners, but we had a variety of options on the table. They wanted to retain, they own a house, they want to move closer to their kids and family, and they wanted to retain their current primary, close on the new one, and then, take a couple months to comfortably move in and then sell their house that they're departing from.
Okay.
If you can afford that, that's great. A lot of people can't, and they have to do contingent concurrent closings, and that's probably what the vast majority do. And that's ultra stressful as well. It's hard enough just trying to secure a property. You're getting outbid, sometimes 10, 20, 30 times. So that can be difficult. But then when you add into that where you're juggling the people buying your house and their financing, and it's a lot. So these people wanted to retain it, and they didn't qualify without us basically creating a way to offset the mortgage payment on their departing residence. And the other thing we had to do to get creative is they've got a bunch of money in pension and retirement, but they weren't drawing from it. So Fannie Mae will allow us to initiate a draw and basically start taking a draw to create income on that pension, and then we get to use that for income qualifying as long as we show proof that it's coming into their account before we're closing, which is kind of a useful tool that probably not a lot of people don't know of, but we were doing that. And so we found an option to get them into a conventional loan, which was great. Before that, we were looking at like a no-income doc,
right,
primary residence loan product, which I just learned 3 days ago was taken off. The lender lost it, and they said it'll probably be 60 days before they get it back on the market. So everything's fluid right now.
Right.
There was a nice aggressive stated income owner-occupied kind of a loan, but now that's gone away. But fortunately, we found a more creative way to get them into a conventional loan. That's kind of long-winded, and I might be speaking a foreign language to some people explaining this. But, this is where I think I provide the value, is just researching and finding a way. It's easy to say no, but we didn't, and now we've got a good option. Now they got outbid by an all-cash buyer on a hot market, kind of near Tacoma, Washington area, and we'll go after another one.
It's funny, real estate everywhere, there's a scarcity of product. I was reading or on an earlier segment talking about how, properties in general are down about almost 10% from a year before, meaning that there's less on the market today than there was. And do you think that translates because even higher rates pushing more people out of the market, or is it still, as you said, in certain markets, certain areas, affluence is affluence and people still want to buy?
It's a mix, but yes, I think it's pushing a lot of people out. Orange County is another in Southern California that is hot. My brother-in-law's put in literally like 40 offers over the past couple of years, keeps getting outbid. everything up there, and he's reached a point now where it's too much. He's like,
Right.
I'm just gonna take a step back and wait 6 months, wait into Q1 or 2 of next year, and look there. So I definitely think it pushed people out 6 months ago, and then there were some that stuck into it. And now they're like, okay,
Right.
the rate's going up again 3 days lately. I just feel like it is definitely pushing, and I don't think you have as many cash buyers wanting to come in because they don't see the return. They don't see the upside of like the market appreciating so much. So, we don't. Lord, no, you know this. We don't
Yeah.
need the rates to go up to slow this market anymore. It's just going to make it that much more difficult and really probably drop the hammer on it. I don't. Yeah. I don't know. I'm rambling now, but
I agree. The difficulty is we don't know, and if I could say, look, this is as high as the rates are going, people would get a little bit more relaxed because then they could really pencil out what they could afford in the future. But if real estate prices keep going up, they get outbid. What are they going to be able to afford? Next month, next year.
Yeah.
It's just a formula that doesn't really bode well for confidence in the marketplace, which is why I guess the confidence rate went down last month. As opposed to previous months.
Yeah, I feel like genuinely the past 2 weeks is the first time in the past year I felt like maybe I should be telling people to get more aggressive because, it's like you're right. It's terrible how high the rates are, but it looks like they're going to continue to go up. And so,
right.
Heck, if you can get the right place that you want to retain and just long play, as long as you're not trying to do a quick flip or sell it in a year or two or whatever, then grab it, hold on to it, and then as soon as we can refi, we will. But yeah, it's interesting. We all did kind of think like we had reached the apex a few months ago.
I know,
and now it doesn't
right.
seem like it's doing that. So.
Hey, Luke, I'm at the end of my time here. Thanks very much for coming on. I always love talking to you because you got a lot of good sense about the marketplace, and you're willing to talk about the specifics of how to get somebody a loan. Thanks very much. You want to tell everybody how they can get in touch with you?
Yeah, thanks, Jeff. My cell phone, you can reach me direct, is 818-209-2592, and I'll just email luke.malibufunding@yahoo.com.
Excellent. Luke, thank you very much again for coming on the show.
Thanks, Jeff. Appreciate it.
Thank you. That's Luke Mankey from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We bring this show to you each and every week, and we've been doing so for 10 years plus. The beauty of this show is that you can long view what we've done and what the market is going to bear in terms of both the availability of properties, where mortgage rates sit, products in the mortgage marketplace, the availability of money. There's a lot of different ways by which this show can help you make decisions about buying and selling. It's really quite simple. Driving around on Saturday afternoon, going to the hardware store, or maybe on Sunday, coming back from church, listening to the show. That's what we're here for. We are giving you information so you can make the best choices possible. Now, I'm not the expert, okay? I'm just the guy facilitating. The experts are the people we bring on. Chris Pyro joins us. He's from Searchlight. Searchlight Lending, Chris, is that what it is?
Yes, sir. Searchlight Lending.
Excellent, and they've been in business quite a long time, like Malibu Funding, the sponsor of this show, and we're really pleased that he's been on the show. We've been doing business together for some time. Chris, how are you?
I'm great. Just in this market, everyone's a little slower, and luckily we're busy still. So such is the business we made, and I guess where we stand.
Okay, so. Let's talk some about the market. I know off air you were talking some about your expertise in the San Bernardino Riverside markets, which I truly appreciate because they've been part of our audience for a long, long time. Give us a little update as to what's happening in that market, both from a standpoint of available product as houses and, of course, mortgages and the availability of money to be able to lend.
Well, I'll start off by saying my knowledge of the Inland Empire area, and hello everyone from the Inland Empire area, is that I am a UC Riverside alumni, accredited business school, graduated there in, let's say, 2000, 3, so haven't been back in a bit. But that being said, we're not realtors. We service all 50 states and even some international. So as far as having a pulse on the local market there per se, I wouldn't say we're the expert other than our dealings or transactions with realtors. But, what we're seeing in the purchase market is, of course, interest rates are higher, affordability is down, and a lot of people are using more down payment assistance, FHA loans, et cetera. So, of course, the volumes are down both on the realtor inventory side, which, of course, affects transactions for us because if people aren't buying or selling, they're not needing money. So it's a double-sided effect.
Do you see a lot of cash transactions? Do you see any kind of movement away from that? I know for quite some time, even during COVID, after COVID, and sort of the recovery from COVID, we were seeing 25% of the purchases still cash. Are you still seeing this as well? Do you know?
I mean, I'm probably even seeing that increase.
Okay.
I'm amazed that people are sitting on these piles of cash. I wish I had that, and
Me too.
I'm sure a lot of people do. But, I'm seeing bigger down payments because why do a minimum down payment when your interest rates are in the 7s? You might as well put more money down if you have it and lower your payment. And also I'm seeing a lot of buyers assuming or expecting that rates will go down. So what is it? Buy the house and date the rate or whatever.
Right. That's right. Yeah.
But people still have places to live. People have money, but you're seeing, I think, less horizontal moves. So you're not going to move from your $1 million house into your neighbor's $1 million house because your payment's going to go up by 50%. So
Right.
Unless you're moving for work, unless you get a windfall, unless you're selling your IPO, you're probably staying put this time and just seeing where the market goes.
I think a lot of that is hurting the market. I was reading an article, I forget where it was exactly, Housing Wire or something like that, just about how not only is the market been hurt by the 3-4% loans, but because we've been raising the interest rates by the Fed, now tangentially that obviously affects the mortgage interest rates, that the buyers are getting a double whammy and therefore are getting more priced out of the market than they would have been in a normal situation where you didn't have a 3% mortgage.
Correct. Yeah. I mean, these houses, the home prices were inflated, during COVID, and they artificially lowered rates, or however you want to say it, the monetary policy, and printed the money. And when the values went up, they haven't come back down. Usually, when rates go up, values go down, affordability is there. But once again, back to the inventory piece, supply and demand, simple economics I learned at Houston Riverside. If there's no inventory, then people aren't going to, these things are going to cost more, right? So the prices have not come down. Actually, I think, last couple of months, they've actually still increased.
Yep.
And rates are increasing as well. So, I've been in this business over 20 years. I've never seen rates and prices increase at the same time. Usually it's, a cause and effect. So it's wonky. That's the word I've been using.
Right. That's funny. Okay. So now we've seen, as you just described, the conditions in the marketplace. What are the products out there that people are gravitating for as a result? Or is it every product available?
It's every product available. As far as, I guess, on the more conventional purchase side, you're seeing a lot more seller concessions. You're seeing realtor rebates or, giving some of the commission back to buy down the rate. So, as far as buying down the rate, we all know this term points. You pay a little up front, your rate's lower, so it makes it more affordable. I know that buyers are also offering rate concessions and such to make it more affordable. So on the conventional side, you're seeing anywhere from down payment assistance to concessions from builders, rebates from lenders. There's 2-1 buy downs where you can buy your rate down for the first couple of years. So a bunch of stuff is coming out of the woodwork to help people be able to afford their payments.
Okay, and product-wise, what are you offering at Searchlight different that might make you guys a little bit unique?
Yeah, that's kind of a secondary thing. Since people are not buying as much as they have been, we're seeing a lot more rehab, a lot more equity lines. So if your first mortgage is 2.75 and you do need the 100, 200 grand to pay for college or pay for the addition or pay for that kitchen remodel, you'd be almost crazy to double your payment to get a new kitchen sink, right? So a lot of people are getting equity lines, even though, of course, those are tied to prime, so they're pretty expensive. but it's better than paying an overall first mortgage with a higher interest rate. But a lot of people are staying put, hunkering down, putting money into their own properties, whether pulling equity out, whether doing different kinds of loans in that aspect.
Do you explain it as a blended rate when you're using either a HELOC or a full second? How are you explaining when you're trying to qualify the borrower in terms?
I think you use will qualify, but I mean, the benefit or the purpose.
Right.
So if your first mortgage, for our number's sake, is $400,000 at 2.5%, and you're getting a $400,000 second mortgage at 10%, your effective rate is 10 plus 2.5 divided by 2. They're equal, right?
Right.
But if you had a new first mortgage, you'd be at 7.5, 8%. And of course, don't quote me. This is not a rate quote.
No, this is a for example, right? Exactly.
For example. So you got to look at the total cost. I always say the cost of your money. So what is the total cost of your money with scenario A, which is, let's say pulling out an equity line or HELOC or HELoan or these different products that are out there versus going through a first mortgage refinance. And most of the time, unless you have a very small first and you're looking for a really big second, which is rare, it's not worth touching that magic golden first mortgage with a magic number 2 in front of it.
Right. I agree with that. I think that this is one of the things that will plague, I believe, the real estate market, because traditionally you would see older Americans get out of the big house and move into a smaller house, the step-down market, and conversely the step-up market. Well, if that chain gets broken because nobody wants to move because they got a 2.5%, 3% mortgage, this really slows down the transactions that can be had during a normal year.
Yeah, I mean, if you have a $1.5 million value house, even if you're looking to downsize an $800,000 townhome, your payment could potentially go up.
Right.
So why get rid of your amenities in your house to have a higher payment? It's not happening. And then inverse, as you stated, if you have an $800,000 townhome and you have another kid on your way, you're looking for a pool in the yard, your payment's going to double or even maybe triple.
Right.
It's not feasible. You might not qualify. It just doesn't. At this time, and hopefully it changes for everyone's sake, at this time it isn't feasible.
Hey, you know what? We've run out of time. I really appreciate you coming on. Could you let people know how they can get in touch with you and maybe tell them your telephone number or email address, something like that?
Yeah, so of course you can use a good old Google. My name's Chris, last name's Pyro, P-I-R-O, broker owner of Searchlight Lending, small family shop. We're in about 10 states, and we offer all loan types. Emails always fastest. It's Chris at searchlightlending.com, and then my cell phone is 650-773-1866, and you can find us on our website and some more information about Searchlight at searchlightlending.com.
Excellent. Chris, thank you very much for coming on the show. I'd like to have you back again just to get a recap of what's going on in the markets from time to time. I really appreciate it. Thank you.
All right, Jeff. Have a great day and be well.
You too, man. Thank you very much. That's Chris Pyro from Searchlight Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. If you want to see the show online, go to themortgagevoice.com. That's our website. You can see and hear a bunch of our different shows, as well as see and hear a lot of the guests that are on the show. You can contact them directly. It's a great way by which you can follow what we do online on a website. And if you're inclined to also see what's going on YouTube, Jeff Barton, the Mortgage Voice, is our pictorial view on a weekly basis. Same thing. KCAA is the station that we're on. And as I said, we've been doing it a long, long time. And let's get right to it again. I'm Jeff Barton. This is the Mortgage Voice. I wanted to talk just a little bit because we touched upon it in some earlier segments about the difference between certain economies, philosophies, how things work in the world, and the competing interests. And now why does all this affect you? It's because the way the money works nowadays, nobody's separate. It's not like you can say, hey, you know what I'm doing out here in Southern California isn't affected by what goes on in the Caribbean or what goes on in Massachusetts or in Michigan or everything else, because we are very, very interconnected. Not only that, we're connected with what happens in Mexico, and we're connected with what happens in Canada, and we're connected to what happens overseas, certainly in China and India and the European Union. All of these places affect the money supply and how we're able to buy and sell here in the U.S. Yes, we're a consumer-driven economy, and because of that, you have choices. But a lot of times, as I always complained about the gas prices, is another example of things you have no control over. So when we get into the us versus them argument, like we're better because, or they're worse because, it's really missing the entire interconnectedness of economies around the world, and the decisions that you make are really not as free as they might want them to be. So what this leads me into talking a little bit about China, as I always talk about China, because I think, when the Walmartization of the world happened back in the early 2000s, late 90s, early 2000s, when everything became cheap and we fell in love with the cheap stuff that we could buy at Walmart, the economy that really benefited from it was the Chinese economy, because they became the supplier of all this cheap stuff because they had cheap labor. I mean, let's face it, that's the exploitation of labor around the world continues, and it certainly in that particular part of the world during those times, during the last 40 years or so, building the middle class in China, taking 400 million people from poverty and putting them in housing in middle class jobs around the country. And part of that was the export of cheap goods to the U.S. and to Europe. Well, because of the nature of the way things happen, change is inevitable, and it happens whether you want it or not. And we now are dealing in a different kind of situation with the importing of cheap goods from around the world, where that has ceased to be the benefit that we saw globalization take effect during the Clinton years, meaning that we could outsource and move our supply chains to here and there and everywhere just as long, and that really was like I say, it was a way by which to say, look, they can make it cheap there and sell it cheaper here, even shipping it halfway across the world, then we can do it here in the U.S., because in the U.S. we have labor protections, we have minimum wage, we have all these benefits that a lot of companies demand, and rightfully so, in my opinion. And now that we see the cheapness of goods not being so cheap just because the baggage that's carried along with it is the social implications of certain governments, certain economies around the world, and how we deal with it. But the decoupling, the non-globalization, that's not going to happen, and it's never going to happen, because what was in China is now in Vietnam, what was in India is now in Mexico, and vice versa, and will continue to change around the world, because cheap labor is cheap labor, and corporations, being what they are going to be able to exploit that. Now, we in a capitalist world say, hey, look, we're going to buy what's best for us at the cheapest price, and that's kind of the way it works. If we look at the way the U.S. economy is structured, and we always say yay for us because it's good, and when it's bad, we say it must be the government's fault. This is how we do it in the U.S. Well, in countries like China, the way they do it is that traditionally, they have, the last 40 years, I say traditionally, they've worked to try to implement what we do in the West, which is be a supply and demand type structure, a consumer-dominated choice economy. Well, because of the changes that have taken place, where China has gone more now towards a centralized control, we say here in the West, oh man, that's awesome, because we've shown that capitalism is better, and the Chinese are bad, and they're doing bad right now, which they are doing bad. And we've chronicled that on this show for months, maybe even a year before anybody else is doing it. Go to any website, any browser, and just scroll down the main page, and you'll see articles on the Chinese economy and what's happening over there, whether it's with Evergrande or Country Garden, the builders, or whether it's the municipalities borrowing up to $10 trillion, the hidden debt in China, or the disappearing of economic news in general. So it sours foreign investment because we just don't know what's going on. We don't know what the actual numbers are when it comes to youth unemployment. Although last month in July, we saw that 20% of the youth, now youth is anybody under, I think, 21 or 18, 20% are unemployed. Big number. And in China, that's a really big number when you're dealing with 1.5 billion people. But here in the U.S., we are dependent still upon the manufacture of cheaper goods in foreign countries to be able to live the lifestyle we can live. Now, we talked about inflation a lot during this last year. Inflation itself is really just, can we continue to buy cheap stuff around the world, or does the U.S. oversupply of money affect prices and therefore increase the cost of those cheap goods here in the U.S.? This is all part of a global look at things, meaning that because we're interconnected, we have to be able to see, is China and the Chinese economy and the difficulties they have. I looked at it 3 weeks ago and said, look, like in the West, if things go bad in your economy, you're going to start a war somewhere. So is that what's happening with China in Taiwan? That's the first thing you have to look at. Secondly, if in fact we go back to more of a what do they call it? The bamboo curtain approach, whereby they're them, they are insulated, and they don't really let anybody else in, and we then have to reroute what we're trying to do with them to someplace else. Is that good for you, the consumer, or is it good for what we consider as a global economy? The more you're interrelated, the less you're likely to get into a fight with those that are trying to help you live a better life. So all of these things are important for one reason: paying attention to the money supply and how you're going to get your loan. The supply of housing in the U.S., where's the material coming from? Where are the nails coming from? Where's the wood coming from? It's not all domestic, and it's not all driven by U.S. demand. A lot of it has to do with the supply that is readily available in other places that isn't readily available here. And the demand for, let's say, things like copper and lithium for the batteries of the future in the EV world are going to come not from the U.S., they're going to come from other places. So the interconnectedness and the openness of markets around the world really play into this. How is it going to cost you to buy a vehicle that in certain areas are going to be cheaper because the materials are made there and the car is made there, the parts are made there? All of this is the macro view of what we've been trying to talk about on this show for at least a month, if not 6 months. And I think a good way to look at it is, are you better off today than you were yesterday or last week or last month? Are you working? Can you get as much money today as you've ever gotten? Or are you in a squeeze that puts the corporate look at how you are as an individual and as an employee? Are you on the block? Are you in the same vein as a corporate worker or an employee in China or in other places? It's a very interesting look at it. I know we all get lost in the conversation politically, but this is an economic issue having to do with whether you can afford a house, whether you can afford a monthly payment, whether there are houses even available, and why aren't there houses available? I'm Jeff Barton, your voice in the mortgage industry. Appreciate you listening. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
KCAA is your CNBC News affiliate. We're the station that gets down to business.